Yeah, no, it's a great setup right now, thinking about a risk-on market like we have seen for the last few days in the middle of earnings season. And, earnings and corporations just confirm the environment that basically shows that there's two things. Consumers are really healthy, and definitely the demand is there. The pent-up demand that has accumulated with excess savings and extra liquidity that they have continues to provide significant support for anything that has to do with corporate earnings down the road. On the other hand, corporations, clearly still have that pricing power. The nature of the challenges that they have in profit margins, continues to be something that they can still pass to those consumers. And I think that dynamic is reflected in the results so far. That the expectation that the deceleration of earnings will come into the first quarter is there, and the market seems to be adjusting very well to it.
Okay, so when somebody like Paul Tudor Jones comes out, as he said on our air earlier today, that the number one issue facing investors right now is inflation, and that it's pretty clear to him that it's not transitory. We've heard some similar commentary from some other high-profile investors in recent weeks. You think what?
Well, two things. There will be components of inflation that will not be transitory. And I think what we see in the imbalances of the labor market basically clear that. There is a growing wage growth situation. We see that the quit rate of people changing jobs, it is increasing, by around 3 to 4%. That obviously puts pressure on wages that will create, inflation that is not necessarily going to be transitory. On the other hand, that's actually good inflation. Inflation is not necessarily always going to be wrong. As long as you can have an economy that is growing, inflationary pressures are actually healthy. And on the other part of this is the Fed. And the Federal Reserve, providing that excess liquidity and taking a very, very conservative approach on how they're going to increase rates, it's something that could potentially, set off down inflation. So I think the big question mark is timing. How much of these imbalance on the supply chain disruptions will last that could potentially have a more everlasting inflation pressures that could be damaging to the economy?
So how would you counsel investors to be positioned within this market right now?
Well, things that we discuss with investors is that, if you look at the snapshot of today's markets, whether it's, yields on bonds, whether it's the equity market, whether it's the dollar, whether it's commodities, and you actually go back to where we were pre-COVID, we pretty much have, recovered completely, and we went into an expansion. So, the full global recovery and everything else has actually moved into the next phase of the business cycle. And as such, our advice is to start looking for transition away from the cyclical recovery part that we had, at most of this year, and moving into higher quality, looking for, expectations of higher rates, higher levels of inflation, higher levels of growth, at a decelerating rate, but still above average growth, and therefore start moving more towards cyclical quality growth companies that actually could benefit from the next phase. Most of that, not necessarily being defensive, but certainly looking for higher quality companies.